When should you use a collar strategy? Have you ever wondered how to protect your investments while still having the chance to benefit from potential gains? The collar strategy might be just what you need. This approach is a risk management technique in options trading that can help you secure profits while limiting your potential upside. So, when should you consider using this strategy? Let's break it down. First, the collar strategy involves two main components. You buy a put option, which acts like insurance for your stock. This gives you the right to sell your stock at a predetermined price if the market price drops. This way, you can protect yourself from significant losses. On the other hand, you sell a call option, agreeing to sell your stock at a specific price in the future. In return, you receive a premium, which can help cover the cost of the put option. However, keep in mind that selling a call limits your potential upside if the stock price rises significantly. So, when is it a good time to use a collar strategy? One scenario is when you want to manage risk. If you own a stock that has appreciated in value and you are optimistic about its long-term potential but uncertain about its short-term performance, a collar can help. It sets a floor with the put option and a ceiling with the call option, allowing you to protect your gains without fully exiting your position. Another reason to use a collar is for cost management. The premium you receive from selling the call can often cover or partially offset the cost of buying the put. This makes the strategy more cost-effective, especially if you want to avoid spending extra money on protection. Flexibility is another advantage of the collar strategy. You can adjust the strike prices for the put and call options based on your risk tolerance and market expectations. This means you can tailor the strategy to fit your specific needs. If you find yourself uncertain about the short-term prospects of your stock but still believe in its long-term potential, a collar can provide the protection you need. Additionally, if you have made gains on a stock and want to protect those profits without selling, this strategy can be effective. Lastly, the premium from selling the call option can generate short-term income, which is beneficial if you do not expect significant price movements in the stock. In summary, consider using a collar strategy when you want to balance risk management with potential income generation. It is particularly useful in situations where you are uncertain about short-term stock performance but remains optimistic about its long-term prospects.